There's an entire generation of people who remember both writing checks at the grocery store and using Apple Pay, and financial psychologists can't quite figure out where to put them. If you were born between 1976 and 1985, you're financially bilingual in a way that doesn't fit any generational stereotype. Too skeptical about debt to be a millennial, too comfortable with fintech to be Gen X. You learned to balance a checkbook by hand, but you also have 7 different payment apps on your phone. You're what happens when someone grows up with cash envelopes and comes of age during the worst financial crisis in 80 years. And the way you handle money today is a direct result of living through both of those extremes. From the start, you spent your childhood in a world where money had physical limits. If you wanted cash, you went to the ATM once a week, maybe twice if you were really pushing it. And when that money was gone, it was gone. There was no transferring funds from your phone or pulling up another account. You waited until next week. If you wanted to buy something that cost more than you had, you saved actual coins in an actual jar for actual months. Or you put it on layaway and made payments at the store until you'd earned the right to take it home. Your parents probably had a check register, that little booklet where every transaction got written down by hand. Some of you even learned to do this yourselves. You subtracted. You kept a running balance. You knew exactly how much money you had because you'd physically calculated it. This created something that's hard to replicate now, a natural friction between wanting something and getting it. The gap between impulse and purchase was measured in time, in effort, in physical action. And that gap taught you something about delayed gratification that's nearly impossible to learn when everything is one tap away. Then, right as you were entering adulthood, everything changed. Not gradually. Suddenly, you got your first debit card, and suddenly you could spend money without physically seeing it leave. Online banking appeared, and you could check your balance without calling an automated number and punching in your account details. By your mid-20s, you were using direct deposit, automatic bill pay, and maybe even your first rewards credit card. The financial system went from physical to abstract in the exact years when your brain was still figuring out how to be an adult. According to research on neuroplasticity, the prefrontal cortex, the part of your brain that handles planning, impulse control, and weighing long-term consequences, doesn't fully mature until around age 25. A study published in Nature Neuroscience found that this region is still developing well into your 20s, which means Xennials were still in this high plasticity window when the entire financial infrastructure transformed. You were young enough that adopting new financial technology felt natural, but old enough to remember what came before it. And that matters more than people realize. Because here's where things get complicated. You entered the workforce right around 2008. Some of you had just started your careers, others were a few years in, maybe finally getting your footing. And then the bottom fell out. The financial crisis wasn't just a news story for Xennials, it was the moment when you were supposed to be building stability. Instead, you watched the entire system collapse. You saw people lose jobs, lose houses, lose retirement savings that had taken decades to build. Maybe it happened to you directly. Maybe it happened to your parents. Either way, you learned a lesson that younger generations didn't experience during their formative years. The system can fail completely and without warning. Research on economic trauma shows that financial instability during this specific life stage leaves lasting marks. People who experience job loss or major financial setbacks in their 20s and early 30s often carry those experiences forward even after their circumstances improve. It shapes risk tolerance, savings behavior, spending patterns. You might be doing fine now, objectively. But there's probably still this quiet voice in the back of your head asking, what if it happens again? So you've got this strange combination. You're comfortable with technology, you can navigate crypto and robo-advisors and high-yield savings accounts you've never physically visited. But you also can't quite shake the feeling that it could all disappear. You might max out your 401k and also keep a separate savings account that you refuse to touch. You'll use credit card points strategically, but get uncomfortable if the balance isn't paid off immediately. You understand investing, but you also remember watching the market cut retirement accounts in half seemingly overnight. And then there's the privacy piece. You grew up in a world where personal finances were genuinely private. You had no idea what your neighbors earned, what your co-workers had in savings, whether your friends were in debt. Money was something you didn't discuss, but now you're living in an age where people post their net worth online, share their side hustle income, screenshot their investment portfolios. There's this constant social comparison that simply didn't exist before. And if you're a Xennial, you probably have a weird relationship with this. You understand the transparency, maybe even participate in it sometimes, but part of you still finds it deeply uncomfortable. You have access to infinite options now, 50 different investment apps, 100 different banks, unlimited credit if you want it. But you grew up with real constraints. One bank in your town, a credit limit that actually meant something, the physical impossibility of spending money you didn't have access to. So now you're navigating this world of abundance with the psychology of scarcity. You might research a purchase for weeks even though you can afford it immediately. Or you'll be incredibly frugal in one area of your life and surprisingly loose in another. You probably also check your bank balance way more than you used to. Maybe not as obsessively as younger people who grew up with this, but more than you'd like to admit. There's something about having real-time access to your net worth that changes the relationship. When you checked your balance once a month via a paper statement, money felt more stable. Now you can watch it fluctuate by the hour, and that does something to your nervous system. What seems to define Xennials financially is this ability to hold contradictions without it feeling strange. You're frugal and indulgent, anxious and optimistic. You trust the system enough to participate in it, but skeptical enough to always have a backup plan. You remember what it felt like when spending money required actual effort, but you also can't imagine going back to that. You lost something, that natural friction, that forced patience, that clear boundary between what you could afford and what you could access credit for. But you gained tools for building wealth that previous generations couldn't have imagined, and resilience from surviving a financial crisis during your formative years. If you're a Xennial, you probably feel like your money habits don't quite make sense to anyone else. Too cautious for some, too willing to embrace new financial technology for others. Caught between two financial worlds. But that's not a flaw. That's actually the defining feature of your financial identity. In a world where money moves faster than anyone can track, having learned to manage it when it moved slowly might be the most valuable financial education you could have gotten. You learned that money is both abstract and real, that systems can fail, that access isn't the same as affordability, and that sometimes the old way of doing things had friction built in for a reason. Not because you're special in some superior way, but because you lived through a specific moment in financial history that taught you something the rest of us are still trying to figure out: how to adapt to constant change without losing sight of what actually matters.